3.9%. If that number is sitting in your retirement portfolio right now, disguised as a blue chip dividend, this video is going to reframe everything you think you know about United Overseas Bank. Today we go behind the headline profit to find out whether the yield is a sanctuary or a slow leak. I have been watching this one for a while. My job is simple, even if the balance sheet is not. I read the numbers that the headline skips, the interest coverage, the gearing, the free cash flow sustainability, so that the Singaporean building or living off a dividend portfolio gets the same forensic clarity that institutional money takes for granted. Turning to the headline versus the reality, United Overseas Bank just reported a 1.44 billion Singapore dollar net profit quarter. On the surface, the market loved it. A headline beat usually sends retail investors rushing in, but as we always say, the headline is for the crowd and the forensic breakdown is for the owners. The underlying mechanics tell a much more complicated story. A 3.9% forward ordinary yield simply does not yet clear the forensic bar that your retirement capital deserves. We need to look at what the market is missing. To get that institutional-grade clarity, we have to look through the forensic lens. We are reading the numbers that the glossy headlines skip over, specifically the interest coverage, the gearing, and the sustainability of that free cash flow. For a Singaporean building a dividend portfolio, these are the only metrics that actually determine if your lifestyle is safe. We will be auditing the net interest margin compression, the contraction in fee income, and the strength of the balance sheet against the forensic minimum yield hurdle of 4.7%. The fundamental engine of any bank is the net interest margin, or NEM. This is the gap between what the bank earns on loans and what it pays to depositors. In the first quarter of 26, the bank reported a NIM of exactly 1.82%. Asset repricing was a major drag, pulling the margin down by 0.14 percentage points. Management fought back by managing funding costs, recovering 0.15 percentage points. The net result is a NIM that is down 2 basis points sequentially and 18 basis points year on year. We are seeing a structural decline from the peak of 2.00% during the aggressive rate hikes of early 25. The era of easy banking spreads is officially over. Management is guiding for a full-year margin between 1.75 and 1.80%. A floor is finally visible. That shows competence and discipline. But we have to be honest about what a shrinking margin does. It mathematically constrains the ability to grow dividends without burning core capital. Looking at fee income, we see a nuanced and slightly softer picture. Net fee income came in at 637 million Singapore dollars. That is a 2% recovery from the previous quarter, but an 8% contraction compared to the exceptionally strong period 12 months ago. Wealth fees hit 219 million. Trade fees held up at 256 million. The softness is mostly in credit cards normalizing from a seasonal peak. It is not a broken engine, but it is not firing on all cylinders yet. And here is the part that matters. The metric management spent the least time on was that year-on-year 8% contraction in fees. They are focused on the sequential recovery, but the real issue is structural. While interest margins compress, the non-interest fee engine needs to step up meaningfully to compensate. At the current trajectory, it is growing, but simply not fast enough to offset the margin headwinds. Management is guiding for high single-digit fee growth for the full year. If they deliver, the second half of 26 will look much better than this quarter suggests. The balance sheet is where this bank genuinely earns its stripes. The Common Equity Tier 1 ratio, the core capital buffer, stands at 15.3%. That is well above the 12% regulatory minimum. The non-performing loan ratio is steady at 1.5%. Non-performing asset coverage is high at 272% when you include collateral. Credit costs are at 26 basis points, right inside management guidance. This is a bank managing risk exactly as promised. Now for a reality check on pricing. The current price is $36.57, while the fair value sits at roughly $38.27. Think of it like waiting for the year-end sale at Pangzone Orchard Road. You know the quality of the product is high and you have done your homework. But walking in at full price before the sale starts is just impatience dressed up as conviction. We are waiting for a price that makes sense for a household budget, not just a headline. Which brings us to the yield stress test. My forensic floor for retirement capital is a 3.2% personal minimum. When you look at today's risk-free rate of 1.40% for a 6-month T-bill, you realize my floor is anchored to long-term stability, not just today's rates. We add a mandatory risk premium of 150 basis points for equity complexity. That brings the minimum yield hurdle to 4.7%. That is the bar that must be cleared. The forensic reality is that the current ordinary yield of 3.9% fails that hurdle by 80 basis points. That is the gap. But this gap is bridgeable. A modest pullback in the share price or a resumption of dividend growth as the margin floor becomes visible in the second half of 26 could close this. We are not avoiding this name forever. We are acknowledging that at this specific price point, the yield does not yet compensate you for the risk. Looking at the income sustainability scorecard, it is a string of forensic failures against the benchmarks. Net profit is down 4% year on year, trailing the 1% growth seen at DBS. Net interest margin fell 18 basis points, wider than the sector benchmark. Net fee income failed to keep pace with the record highs seen elsewhere in the market. The bank is profitable, but it is underperforming its peers on these core income sustainability metrics, and that puts pressure on the dividend narrative. The debt health table is a sea of green passes. The capital ratio is strong at 15.3%. Loan quality is healthy, non-performing loan ratio well below the 2% threshold. And the interest coverage ratio actually improved to 9.3 times, up from 7.2 times. Operating earnings are more than sufficient to absorb credit losses. While income growth is slowing, the structural integrity of the bank is not in question. To summarize the scorecard, net profit of 1.44 billion Singapore dollars, a 4% drop year on year. The margin of 1.82% shows the full impact of the rate environment. Fee income of 637 million is still finding its feet. The standout figure is the interest coverage of 9.3 times. The bank is absorbing credit losses comfortably, which means the dividend is safe from a cut, even if the growth of that dividend is currently capped by the margin pressure. There is one data point the market largely missed. Greater China. The non-performing loan ratio there has crept up from 2.7% a year ago to 3.5% today. That sounds alarming, but management is ahead of it. They have proactively increased general allowances on China performing loans from 1.2% to 1.9%, building provisions before the stress fully materializes rather than scrambling after. That kind of forward-looking risk management gives forensic comfort despite the rising headwind. In our scenario analysis, the base case carries a 60% probability. This assumes an ASEAN soft landing and the margin stabilizing near 1.80%. In this scenario, we expect flat to modest dividend growth with a yield staying between 3.9 and 4.2%. This is a watchlist situation, not a distressed one. The bull case requires a rebound in rates and fee guidance being exceeded. The bear case involves the margin dropping further and China deteriorating beyond current provisions. My forensic verdict on management credibility is constructive on risk, but skeptical on the income narrative. On one hand, the 15.3% capital ratio and proactive China provisioning show a team running ahead of their exposures. On the other hand, the income story focuses on the quarter because the full year shows structural margin compression that has not bottomed. The bank is sound, the price is the problem, and only one of those is in management's hands. You should not be reading this alone. In this market, the difference between a sanctuary and a yield trap is often decided in a single trading session. While free subscribers are reading yesterday's story, my elite investors are cross-checking the next setup together in real time. We look at the same data, but we do it with the collective wisdom of a community that refuses to be exit liquidity for institutional players. Iggy's elite investors get the full forensic picture the moment it is finalized. Zero-day breakdowns before the market opens, and complete institutional-grade cheat sheets built on the 5-layer audit. For 9 Singapore dollars a month, less than a kopi and kaya toast set at Raffles Place, you get the tools to stop guessing and start analyzing. It is about having the data in your hands when it actually matters for your wallet. The portfolio role conflict here is clear. A core holding classification is incompatible with a Zone 4 caution rating and a yield trap verdict. For now, this is a watchlist name opportunistic only. We look to accumulate only if the forward ordinary yield reaches 4.7% or above. Until then, we maintain caution. Patience is the most underused tool in the retail investor's kit, and this is the time to use it. Looking at the forensic zones, Zone 1 is the fortress where we want our retirement-grade assets, requiring a yield above 5.5%. United Overseas Bank currently sits in Zone 4. With a yield under 4.7%, it is in the caution category speculative for income seekers. It does not mean the bank is failing. It means the price is not offering the safety margin required for a retirement portfolio focused on sustainable yield. Here is the honest summary for the Singaporean investor. The bank is not the problem. The balance sheet is disciplined, risk management is proactive, and management delivers on its promises. The price is the problem. You are being asked to pay for a 3.9% ordinary yield when your retirement capital deserves 4.7%. Never settle for less than your capital deserves just because a name is familiar or a headline is bright. We watch, we wait, and we know our price. Monitoring the yield is the priority. We wait for that 4.7% crossing before we act on the signal. This is not a name to avoid forever. It is a name to watch with extreme patience and a very clear target in mind. The work is done, the forensic levels are set. Now we simply wait for the market to give us the entry we want. The kopitiam uncle does not leave in a huff just because the wonton noodles are not on offer today. He notes the price, finishes his kopi, and comes back when the timing is right. That is the posture zone 4 is asking you to hold. Discipline over impatience. We know the quality is there, so we can afford to wait for the right price. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. The 7-day embargo window is where the market moves, and our community is there first. If you want to stop being exit liquidity and start seeing the red flags before they hit your wallet, join us at the link below. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.